So, right now in the markets, there's this incredible tug of war going on. On one side, you have all this fear swirling around the big picture macro economy. But on the other, there's this intense fear of missing out coming from major institutions. And believe me, these two forces are pulling the market in completely opposite directions, creating a huge disconnect for investors. And this really breaks it down for you. In the macro fear corner, you've got serious doubts about whether the Fed is actually going to cut interest rates, and that's sparking a pretty big sell-off in Bitcoin. But then you look at the other side, institutional FOMO, and you see absolute game changers like BlackRock making its first real move into DeFi, that's decentralized finance, plus a steady drumbeat of positive adoption news from all over the world. All right, so how do we make sense of all this? Let's try to decode this battle. You've got these powerful macro headwinds pushing everything down against these massive institutional tailwinds that could send things flying. Okay, first up, let's talk about the fear side of the equation. Now, this might sound a little backward, but right now, strong economic news is actually what's freaking out the crypto market. Let's dig into why that is. So it really all boils down to this. A surprisingly strong jobs report just came out. Now, in a normal world, hey, that's fantastic news, right? But for the markets, not so much. A hot economy means the Federal Reserve has basically zero reason to cut interest rates, so the market is suddenly having to accept that these high rates could be here for a lot longer than anyone hoped. And you can see the effect plain as day. All this pressure over rates has sent Bitcoin, which really leads the whole market, sliding down toward that really important psychological line in the sand of $60,000. See, when rates are high, safer investments that pay you interest look a lot more attractive, and that pulls money away from riskier bets, like crypto. And this isn't just us talking, we're hearing this from some of the biggest names in the space. Mike Novogratz, who runs Galaxy Digital, came out and warned that because of this whole new macro environment, the entire crypto world might be in for a period of lower returns. And this right here shows you how the ripple effects are spreading. It's not just about the price of Bitcoin anymore. S&P is now pointing out that even more complicated financial products, like bonds that are backed by Bitcoin, are now facing a major stress test because of all this price movement. It just goes to show you how connected everything has become. But here's where it gets really interesting. Just as the macro picture looks grim, the big institutions are hitting the gas hard. While the average person might be feeling nervous and prices are dipping, some of the biggest players in finance are making their move, and it's creating this powerful counter-narrative. I mean, check this out, a sudden 25% surge. And no, this wasn't Bitcoin or Ethereum. This was the price jump for a token called Uni, and the story behind it is a perfect example of the institutional FOMO we're talking about. Here's the bombshell that caused it. BlackRock, the largest asset manager on the planet, just waded into the world of DeFi in a huge way. They listed their tokenized fund on Uniswap, which is a major decentralized exchange. I mean, you can't get a bigger vote of confidence in this new technology from the heart of old-school finance. It's massive. And this BlackRock news isn't just some random one-off event. It's happening as part of this bigger global wave. You've got Thailand's regulators giving the green light to crypto derivatives. Then over in Europe, Danske Bank, which fought it for years, is finally letting its customers buy Bitcoin. Oh, and Binance just moved $1 billion of its own protection fund into crypto. The dominoes are definitely starting to fall. And, this whole push and pull, this battle between innovation and fear, it's not just a crypto story. Not by a long shot. We're seeing these same conflicting signals pop up all over the tech world, and even in the good old traditional stock market. Just take AI, for instance. On the one hand, you have this mind-blowing expansion, like someone paying $70 million for the AI.com domain name. But on the other hand, that same exact technology is causing contraction. You see U.S. brokerage stocks taking a nosedive, precisely because a new AI tool could make their business model obsolete. It's a perfect real-time example of what economists call creative destruction. And then, just to stir the pot a little more, you have other wild signals getting thrown into the mix. For instance, former President Trump just made headlines saying he wants to see the Dow Jones hit 100,000. Now, whether you think that's possible or not, it's a bold claim that just adds another layer of debate and speculation to everything. Okay, so with all these forces pulling in different directions, how on earth do you navigate this? Let's try to boil all this conflicting noise down into a few key things every investor needs to be paying attention to right now. So here's the bottom line. First, the market is basically a battlefield right now between short-term macro fear and long-term institutional adoption. Second, and this is crucial, for day-to-day price moves, interest rate policy is still calling the shots. But third, and this is the long-term view, you can't ignore these institutional moves into DeFi. They signal a real fundamental shift is happening. And finally, remember this is all taking place as tech disruption across the board is speeding up, not slowing down. So that really leaves us with the billion-dollar question, doesn't it? As we look ahead, which of these two massive forces is going to win out and define where the market goes next? Is it going to be the short-term fear that's driven by all this macro data, or will it be the long-term conviction we're seeing from the biggest institutions in the world? That is the great disconnect we'll all be watching.